Hey, how's it going out there? Today I'm going to give you a beginner's guide to investing. Combination of things I've learned over my graduate career and a couple books I read. So let's get into it. I'm going to break it down into three biggest do's and don'ts. First, this is a quote I learned from Warren Buffett. Pick a business, not a stock. It's real easy to get tricked into buying a stock because it sounds good, but really look into the business. Do you think the business is going to be prosperous over the next year, 5 years, decade, even more? Or do you think it's just something that's popular right now? So when you're really looking at a stock, don't think about it as a stock. Think about it as a business. And that's something he is very keen on, him being the best investor of all time. I think that's great advice. 2, buy cheap and sell high. As a rule of thumb, think the opposite of everybody else. This is another theme that Warren Buffett stresses a lot. When the market's low and everybody's feeling really reserved, that's the time to buy. Like in 2008 when we had that crash, that was the best time to buy. There's been the biggest turnaround. If you bought at the bottom, you would have doubled, maybe even tripled some of your stocks. Next, know the difference between the Roth IRA and a regular brokerage. Something that I'm really stressed about if you're just getting into it, go for the long term because the short term is much harder to beat, and unless you're really going to focus and do some calculations, it's better to just go for the long term. So a regular brokerage is like a regular investing account. You could put as much in as you want. You're going to get taxed and you could withdraw anytime without a penalty. But if you're looking for the long term, which I highly suggest, a Roth IRA is amazing. You can put into $5,000 a year, tax-free, and if you're over 50, you can put in $6,000. And that means when you pull your money out, you're not going to get taxed a dime. So you're 20 years old and you put $5,000 in every year until you're at least 59 and a half. If you pull out $1 million, you're going to get that full million. If you did it in a regular brokerage, you're going to get taxed on that $1 million, and that's going to be a huge sum that's going to go to Uncle Sam. But there are a few situations where you're allowed to pull out a Roth IRA without a penalty. One of the big ones is when you're buying a house. You can pull out up to 10 grand. There's more details, but I'm not going to get into them for this video. Moving on to the don'ts. One of the most important things is don't invest with your emotions. There's two major keys here. One, don't listen to that inside scoop where you hear it at a coffee shop or something where somebody's saying, oh, Norwegian rugs are going to skyrocket this month. Odds are it's either a scam. If it is real, you're going to be too late. And it could just be somebody making this completely up. They invested a whole bunch and they're spreading rumors, and hopefully enough people will buy into it that'll bump it up. And the other side of don't use an emotion is you can't look at the market at a day to day and say this is what it is. The price of a stock does not equal the value. Don't look at it day to day and stress out. You have to remember to think long term. Next, don't try and beat the market. There are just too many factors that go into a stock price. And plus, there's huge investing firms that have invested so much money into analyzing stocks, and they have the best experts in the world, and they still fail from time to time. And in the short term, investing is a type of gambling. If you take a step back, when you put your money into the stock market, you're saying that you believe that company is going to be better than it is today. Finally, don't over-invest. Make sure you're putting your money in when you have a little extra. If you have a large amount of credit card debt or high interest loans, pay them off first. If you have loans that are really low interest, like 3% or lower, that's when you should be putting your money in. Another thing is once you put it in, forget about it. Set it and forget it. It's really easy to look at the market every day and let your emotions play into it. Just put it in, forget about it, and you're better off learning the gum style dance. Find something else to do. And another thing that's really important, don't pay too much per trade. Every website charges you per transaction. Some of them are astronomical, and those are the ones that pay millions of dollars for advertising. That way you can pay half of what the big guys charge. I personally use TradeKing. They're $5 a trade, excellent service, and I've never been disappointed. Now, my three favorite stocks are SPY, which is top 500 companies in the US and consolidates them into one. 70% of your portfolio is S&P, 20% of it is gold because gold normally goes up during a bad market. And then the other 10% I have stocks, and my favorite one is GE. They had the CEO of the century work for them for a while, Jack Welch. He instilled a lot of great values into the company. And on top of that, they pay a dividend. A lot of stocks nowadays don't pay dividends. So I want to thank you guys for listening to the video. I hope I motivated you into investing and prospering in the future. If you're looking to sign up for an investing account, I highly suggest TradeKing. And in fact, if you sign up through the link on my Facebook page, you get a free $50. Thanks a lot. If you have any questions, email me at sankcity@gmail.com. Thank you.